Hi there, eToro. As I said last week, 1 week every month, I will do a review of the previous month. So let's take a look at what happened in March. This is the first of these that I am doing by video, so if there's anything that you think I should add as a topic to this review, please let me know in the comments. Starting with performance summary, my 2022 goal remains 20%. This is below targets for previous years, but this is because we're in an environment where interest rates are rising, inflation is high, and the world is still trying to recover from coronavirus. It's still likely to be a very challenging number to hit this year, but given the weakness in Q1, I expect that the rest of the year will probably be decent. I don't really benchmark myself against any index or ETF, and I'll talk a little bit about why later on. I tend to instead have this annual goal, but the S&P 500 is down 5% year to date, so that's from the beginning of January until the end of March. The NASDAQ 100 is down 9%. My portfolio is down 9%. It's a very ugly start to the year, and statistically speaking, it's quite unusual. Usually January is quite a strong month for the year, but we are living in quite unusual times at the moment. Through last month, we saw the NASDAQ 100 briefly enter a bear market, so that's experiencing a larger than 20% drop from its most recent all-time high, and the S&P 500 entered correction territory. For my portfolio, it was an incredibly volatile month, and for many other portfolios, I think so. My total March performance was minus 4.6%. The March low for my portfolio was minus 16%, and the March high was 0.5%. That tiny bit of green happened towards, I think, the second to last week of March. And then as we got into the final week, I suspect we were seeing some profit taking, but also end of quarter rebalancing. I mean, the NASDAQ had gone from being in a bear market all the way up to minus 9%. So that's quite an enormous rally. And some people probably wanted to take something off the table. I was reticent to put up a 1 month chart of asset performance just because I'm a long-term investor. I don't invest over days, weeks, or even months typically. I tend to hold things for many quarters and even years. But I think that this is an interesting point to talk about any interesting assets in the portfolio, as well as any particular changes that I might want to make. So if you look at the 1 month numbers here, you can see it's largely green, the best performer being Cardano and the worst being UiPath. I'm largely happy with the portfolio composition right now. The only exception being, maybe, is UiPath right there on the bottom, and that's the worst performer. The reason that company experienced such a big drop is, well, they're one of the riskiest companies in my portfolio. They're a high growth SaaS company, software as a service business. They've been growing very strongly in terms of revenue, but they've not yet reached the point of profitability, although it was looking like it's just on the horizon, so potentially worth the risk. However, in their most recent earnings, which is a large part of the reason for the enormous drop, they mentioned that the effect of the Ukraine-Russian conflict will have a material effect on their revenue and profitability. They don't really see that coming through this year. So it's still a very strong company. It just looks as though they might not perform as well as everyone had thought through this year, although over a 2-year period or a 5-year period, I think that they will still do very well. I think that they might be another kind of CRM, Salesforce type company. I also think we're approaching the part of the year and also the part of the pandemic where travel stocks are likely to start seeing a bit more attention. Restrictions are being lifted in a number of places and people are eager to travel. As someone that does travel now and again, I've also seen the prices have gone up significantly, and I, like many others, are willing to pay those higher prices. Just wanted to let everyone know, in case they didn't, that there is something called a fact sheet that eToro creates every month, and it's always available on the same link. You can use this bit.ly link that you see on screen. It's updated somewhere in between the first and second week of each month, and it gives a breakdown on a single page of my lifetime performance on eToro. I've just thrown up the chart on screen, this little gray line. I know my head's covering part of it, but this little gray line is the S&P 500. And you can see that over the period that I have been a user of eToro, that you would have doubled your money if you had invested in the S&P 500. And if you had copied me, which wasn't possible at that point in time, you would have made a return of 532%. This is as of the end of February, by the way. The March numbers haven't been updated just yet. What's immediately obvious is that my portfolio is very volatile, and this is as a consequence of my strategy. So I invest in particular sectors and industries. I tend to concentrate my investments in those areas. I invest in the best companies within those sectors, but they are usually growth type sectors, and therefore the individual companies, they travel in the same direction when there is a piece of news that moves that industry or sector. And this makes for a bit of a wild ride, but that's the price I'm willing to pay for outsized returns. I know I talk about these every week, but I just wanted to, summarize the month, the key events through the month. So we saw the market bottoming, it seems to have bottomed at least, and a very sharp rallying towards the end of the month. And then we saw some profit taking and probably quarterly or month end rebalancing into the final week. At the end of every quarter, big financial institutions, big investment houses, they tend to rebalance their portfolios. The war in Ukraine obviously is still going on. It doesn't seem like it's going to be ending very soon. I'm not sure if you've noticed, but the effects of the war on various assets classes seems to have worn off a little bit. Some commodity prices have cooled down. For example, wheat is well off of the highs. We also saw cryptos rebound. Cryptos tend to travel in the direction of the market, particularly technology stocks. And so we've seen some big jumps in crypto prices. The big news at the moment is that the yield curves are flattening and inverting. And the reason that the market is paying so much attention to this is that for the past 50 years or so, every recession has been preceded by a yield curve inversion. However, that doesn't mean that every time the yield curve inverts that we see a recession. That's actually not the case. We also saw a hawkish Fed, which was expected. So they have said that there will be several rate hikes through this year. And now the big debate is how large those hikes might be. We saw China continuing to become more dovish through the various actions the government has taken through the past, let's say, 2 years. The government has managed to hammer investor sentiment as well as slow down the economy significantly, and now they're looking to turn that around. They've announced a huge number of things in a very short amount of time, and there's usually a lag between when these things are implemented and when they have effect on the market. Investors are just very nervous. It's going to take some time for them to build up trust in the Chinese market once again, but I think when they do, we're likely to see some very big jumps in Chinese assets. We also saw some strong earnings through Q1. There'll always be misses, but there were a lot of very good earnings announced, but it seems quite clear now that the peak of earnings growth is behind us in Q3, Q4 last year, depending on which stocks you were looking at. Now, the counter to the concerns about a recession and the yield curve flattening are that GDP numbers and PMI numbers are still strong in major economies. I know that month to month these numbers are a bit lumpy, but in general the trend is still much higher than it is in normal times. So this is the counter argument to the potential for the world entering a recession. And as is quite obvious for anyone that reads any kind of media, inflation is still quite high. It's not clear if it is topping out just yet. The war in Ukraine has had some unexpected consequences on inflation, but I have been saying since I think late last year that I think that a top out in inflation would happen somewhere in Q1, Q2. So let's see. Now, I wanted to touch on a topic that I think is beyond the scope of this call, but I thought might be interesting anyway. That's the core concept of understanding, first of all, yourself as an investor, but what you want and expect from the market, your investments, your funds, or the people that you might be copying. Now, there are thousands of ways to skin a cat. There are many ways to make money in the stock market. Some of them work, some of them don't, and some of them work if they are aligned with your personality specifically. And I just wanted to highlight, you get investors and you get traders and you get people that are a combination of the two things. And then within each of these categories, there are subcategories. You need to understand where you fit within these different classifications. And you're probably a combination of a few things. Because part of being successful as an investor or even a trader is being disciplined, understanding your process, yourself, your psychology, what your limits are, but also when you can push a little. And the same goes for when you're picking a popular investor to copy. So you might pick 5 different types of popular investors, but it's important to know their style of working and to set your expectations appropriately for each. One might be a crypto investor, and in that case, you're going to experience gut-wrenching volatility well beyond anything that happens in my portfolio, and you need to be willing to wear that probably over quite long periods, years, as a matter of fact. On the other hand, you might also have someone who's your slow and steady, low returns, but very low volatility kind of person. So you would set your expectations appropriately for that person. It doesn't make sense to have the same expectations for all the different types of strategies in your portfolio. Now, I'm not going to read what's up on screen. Maybe you've had a chance to read it already. These are just some classifications. the way that I think about different types of investors and traders. If you haven't had a chance to read it, go ahead right now, but I've split it between investor and trader buckets, the period that they might invest for, the asset classes that they might invest in, and the strategies that they might use. Now, in terms of my particular strategy, I'm a long-term bottom-up investor, mostly. Long-term here being months, quarters, and years. That's the holding period that I have for anything that I buy. Bottom-up means that I place more weight on the fundamentals typically than anything else. So when I find a company, I am aware of the macroeconomic backdrop and the geopolitical backdrop, but it's more the specifics of that company, the management, the products they have, their position in the market, etc., that mean the most to me. I'm typically a GARP investor, so growth at a reasonable price, and this means that I'm a combination of a value and growth investor. I look at growth companies that are good value. As I mentioned before, I like to concentrate my investments in particular industries and sectors. So for example, at the moment, I think that for the next decade, gaming, e-commerce, online payment systems are going to be growth industries around the world, and therefore their stock price ultimately, which can become disjointed from the business performance, will at certain points align. I'm not afraid of volatility. I don't welcome volatility unnecessarily. I don't think that all types of volatility are risk, but through 2 decades of investing, I have built up a constitution that is able to wear volatility and to take advantage of it. For example, like I have now by adding funds. Over the years, I've tried to benchmark myself against various indices and ETFs, but it's kind of tricky because of the concentration and makeup of my portfolio. I think that the closest I can get is kind of the NASDAQ composite and also the IWO, so that's the growth portion of the Russell 2000. However, instead of benchmarking myself against these, I tend to benchmark myself against a particular return for that year instead. I do hedge now and again, and hedging can come in many forms, right? It's not just a matter of shorting an index. It might be a particular asset that you pick up, but there is almost always a cost involved in hedging. And from all of the different investors and traders that I follow and have researched, it seems that those that hedge significantly are willing for their hedges not to pay out 66% of the time, 2/3 of the time also. This means that 2/3 of the time when they hedge, there's a cost to that hedge in some form or the other, whether it's an opportunity cost or an actual cost in terms of fees, and they are willing to wear those for the purposes of that hedge. It should also be noted that hedges reduce the returns of the rest of your portfolio. Now, once again, I do hedge from time to time, but I only do so when I think the market has moved extremely in one direction too far or the other, and I tend to keep my hedges fairly small. And although I've just given you this long spiel about how I'm a long-term bottom-up investor, sometimes I do make momentum or macro trades. Sometimes I will pick up a certain asset that's broken out of a range on high volume, backed by some kind of major news, but this is very rare. All right, so what changes have I made to the portfolio through the past month? Well, I'm largely happy with the portfolio composition. My risk score, some of you will have noticed, touched a maximum of 7. eToro has just changed their rules for risk scores, so I'm still okay in terms of being copied, but I did trim back some of my highest risk positions according to eToro's statistics. I don't think this will materially affect the performance of the portfolio. I've literally just shaved a little off at the top of these, and there are so many opportunities in the market that I've been able to put that money somewhere else that I think will achieve a decent return anyway. I just said it, there are a lot of opportunities out there at the moment, and I am being as disciplined as possible not to spread myself too thin. I do want to maintain a certain level of asset concentration because that's how you achieve outsized gains. And I added funds on the 1st of April. I would have loved to have done this earlier, but I have a lot of copiers, and if I'd suddenly added funds and started buying and selling things, it would have thrown a lot of copies out of sync. So I wanted to leave enough time to communicate this and have added those funds on the 1st of April. I will also likely start using those funds on Wednesday or Thursday of this week. And finally, I wanted to talk about some common questions that I've gotten through the past month and beyond. So why don't you hedge more? I've kind of spoken about that. There's always a cost to hedging. It's not cost free. And that cost reduces your overall returns if you are a long-term investor. Why don't you diversify into commodities and currencies? As I mentioned before, I am a bottom-up investor. I base my investments on the fundamentals of a business, and it's very difficult to determine the fundamentals of commodities and currencies, not only because there are so many influences, but there's no balance sheet or management company, etc., that you can refer to in order to determine what a potential fair value of those things are. To me, they feel very risky, more risky than stocks. and they are subject to very sharp movements on any type of news that you just cannot predict. One of my favorites is X was so obvious, why didn't you buy and sell it then? So this is a bit of hindsight bias. Humans have this error in thinking and judgment called hindsight bias. Those of you that watch my videos frequently will have a little chuckle because I talk about this from time to time. If it was so obvious, then everyone would have poured all their money into whatever that was, and there'd be a lot more billionaires and trillionaires around when it comes to stock investment and trading. This is something good to be aware of, not just, when you're looking at people that you're copying, but also for yourself. Sometimes you might judge yourself quite harshly, saying this was obvious, I should have put more money in this, or I should have sold this earlier, it was obvious that it was going to fall. And finally, the golden question, when profit? Now I'm going to stick to my standard caveat that, I cannot time the market, and no one can really over the long term. But we've just experienced one of the roughest beginnings to a year in terms of trading for a long time. Highest volatility that we've seen in years. There are growth stocks that are still trading as though they are blue chip mega caps, those companies that just about aren't growing at all anymore. In general, sentiment is in the bin. People are worried about a lot of stuff. And this is about the time when I start getting excited about how the market is going to move. When you have the opposite of that, when people are excited and think that they can't lose and everyone's competing about their enormous triple-digit gains, that's when you should be worried. So I think it might take a little bit of a while for confidence in the market to rebuild. This usually happens after any correction or bear market, and then we'll be A for away again. All right, that's it for this week. I will speak to you soon. Goodbye.